All right. Welcome, everybody, to the Finance Essentials Podcast. I am your host, Danny Hudson. Here we are on a Thursday, little later than normal, but a bunch of work stuff came up yesterday, so I didn't have the chance to get the podcast recorded and distributed. I know you guys are all waiting on the edge of your seats, but we are here available today, and I have a super excited podcast. This has probably been one of the most highly requested ones. So I did some good research. Well, I think I did some good research anyway, and as usual, I'm presenting it in the form of a current event. But I think today should be a pretty positive message, and hopefully, hopefully it'll bring some positivity to your world, and also, hopefully, we also learn some stuff, right? Because that's the ultimate goal here is to learn and find a way of financially to be able to tie that into our financial future. So. Let me start off by saying welcome. I really appreciate you guys listening on a weekly basis. By all means, like I mentioned in the past, please feel free to follow me on Twitter. We're also on Facebook. We're also on LinkedIn. We're on pretty much all the social media platforms. Also, to go over to the website, financeessentials.io. Check it out. Let me know what you think. We do actually have, I know I mentioned prior, the webinar. I have completed the webinar. What I'm currently doing now is I'm working through the proper way, in my opinion anyway, as far as the proper way of distribution. My original intention was to actually record it live and have people there. The problem, I think, with that was the fact that it would require people to be available and open at a certain time. So now I'm kind of starting to rethink that. The material is there. I'm hoping I'll be able to get it probably recorded, if not this week, then next week. So I'll actually get it out earlier than my initial timeline was, which was early December. But what this will allow me to do is be able to put it on the website, and then once people purchase it, and again, it's going to be super cheap. I think I've got it set right now at $25. I might take it down to 20. We'll see how it goes. But either way, it'll be $25, which is super inexpensive. But then what it would allow everybody to do is to be able to view it at their convenience, right? So once people purchase it, you'll get the link sent to you, and then you can download it. You can view it at your leisure. But what it'll also allow me to do is it'll allow me to make it kind of a part of a series. So if it's successful, if you guys enjoy it, what it'll be the first part of a series, and then so on and so forth, and I'll be able to kind of expand it, going forward. So kind of a pivot. And I know we've talked about pivoting and innovation when it comes to business strategies and things in the past. And so I think this is probably the most ideal way for me to be able to pivot the business and to be able to provide you guys with the top quality support that I think that I can, as well as the convenience of being able to consume the material whenever you guys have the chance. So that's where I'm at right now. Stay tuned. I should have an update. And if you're not on the email list, go over to the website, financeessentials.io. You'll see it on the homepage. There's a link that's down there where you can sign up for your free cheat sheet. It's going to be super helpful whenever we do go into the webinars. Download that, get added on to the email distribution, and then that way you guys would also see those types of updates as well. So, again, to rehash, thank you guys for tuning in. The podcast that we're going to do today has been highly requested, probably the most highly requested, and I did find a way to kind of tie it into some news. So, as I'm sure a lot of you guys are aware, Pfizer and several other pharmaceutical companies believe that they have come out with a successful coronavirus, a COVID-19 vaccine with over, I think, 90% effectiveness, which is great news. It puts us in a situation where whether or not it's effective to the point where it can open everything back up like normal, that's probably a bit of a stretch, as we've talked about on this show, and as I'm sure you guys have probably discussed with people in the past. I don't know if things will ever go back to normal, kind of the way they were before. Probably very similar to the way air travel was after 9/11. You've never had the situation where, whenever I was a kid, my parents used to be able to go to the gate and help me get on the plane and so on and so forth. Whereas now we have, don't get me started on TSA, but we have new processes, right? We have a new normal. And so hopefully, though, what this will allow is it will allow a lot of businesses, and we'll kind of go into it a little bit more here in a minute, to be able to open up at least at a certain capacity where these complete industries won't die off. So again, it's great news to hear that we've discovered a vaccine. Hopefully it's successful. Hopefully businesses will be able to open back up again. But the article that we're using today actually comes from CNBC, and it's from Holly Elliott. And the title of it is, "Don't be under the illusion that an economic recovery will come quickly with a vaccine," UBS's Weber says. Now, the reason why I'm using this article as opposed to one that is all roses and so on and so forth regarding the vaccine is because this is a finance podcast, right? This is a finance show. This is a finance business. It's not hopes and dreams, right? We deal with data, we deal with economics, we deal with forecasting, we deal with budgeting, so on and so forth. And so the importance of this is that while a vaccine is great news, it doesn't necessarily translate to a full economic recovery the way obviously that all of us would like. So these types of things are important to keep in mind. So Holly basically starts off and she says, the announcement earlier this week that an effective coronavirus vaccine has been deployed or developed was given, a big welcome. As I'm sure you guys have probably seen, the markets skyrocketed. There was a big positive reaction across all the markets. Going forward, I'm not pessimistic. I mean, eventually we'll get through this, but we should not be under the illusion that it will happen fast. It will take some time, Weber told CNBC's Jumana Bertecci. If you're listening, I apologize. I probably butchered your name there. It will be at least a year to get back to pre-crisis levels of GDP, which is gross domestic product, and it'll take another year or two to be anywhere near getting unemployment and pre-crisis growth back. And so it will be quite a long recovery that we're facing. Hopes that life in the economy could get back to normal sooner rather than later got a huge boost on Monday when U.S. Pharmaceutical, so on and so forth, like we've talked about. So how I wanted to tie this into the finance messaging is that I have been seeing a ton of great news on social media and talking with friends, and hopefully you guys have as well, of people who are returning back to work, companies that are rehiring, people that are getting back in the workplace, people that are getting back out there in the job markets, so on and so forth, that are really giving people the opportunity to do what people really need to do, which is get back to work. Now, I'm sure how we define work and work satisfaction and if you guys want to have a philosophical debate when it comes to that kind of thing, we can do that, but we'll save that for another time. What this is actually saying though is that and what we're saying is that people need to get back to work. As we've discussed in the past, the impacts of lockdowns and so on and so forth, it's not good for the economy. It's not good for personal health because people need to work. People, not necessarily work, but people need to have a sense of accomplishment. People need to have a sense of the fact that they are doing something, that they are contributing. I'm sure most of you have probably heard horror stories of people who retire, right? So they work their whole career, 40, 50 years, and they love it, so on and so, why do I keep saying that? But, and then they retire, they get a beautiful gold watch, whatever it might be, and then their health really starts to decline after retirement, and it doesn't end up working out, and we know how the end goes there. And so people really need to feel as though they're being a part of something that they're contributing. So what we're seeing is people that are getting back out there into the workplace, which is great news. And if you're one of the folks that's listening, that recently just started back working again, maybe it's the same job, maybe it's a new job, maybe it's a better job, maybe it's not as good. Let us know. I love hearing success stories, and I love hearing people being upbeat and happy about the future, especially considering what we've gone through over the past, what are we at now? 8 months, 9 months? So that's great. So how we're tying this into the show, and I know a lot of you are probably thinking, well, you said that this was a highly requested show and so on and so forth, but what does that mean? Because you haven't told us anything new. What I wanted to do today is I wanted to review and go over with you guys retirement options. I know that we talk a lot about the financial future, a lot of financial forecasting, a lot of financial freedoms that we can do when we understand the inner workings of finance. Now, a lot of you though who are returning to the workplace and returning to new jobs, you probably had an old 401k, or you probably had an old Roth 401k. You may be going into a new workplace where maybe you've got a new retirement plan, or maybe you're going to be an entrepreneur. And I want to go over what types of options that you have, the financial stipulations that tend to go with those, what you need to look for when it comes to old retirement plans, new retirement plans, what kind of options you have as an entrepreneur, things along those lines. Now, keep in mind, I am not making any financial advice. I am not recommending anything specific as far as investments go. All that I am doing is letting you guys know what type of options people have and what that means. So, for example, a lot of traditional companies, they offer a 401k. I'm sure a lot of you guys are familiar with 401ks. I'm sure that a lot of you guys are very familiar with how 401ks work. There's also a Roth 401k. A lot of companies these days are also offering Roth 401ks. Now, the difference between the two, a traditional 401k and a Roth 401k, is that a traditional 401k is going to be pre-tax. A Roth 401k is going to be post-tax. So what that means is that whenever you get paid, if you have, we'll say you got paid $100 and you have 5% that's going into your traditional 401k. So that it's going to take 5% of your $100, which is $5, and it's going to deposit that into your 401k. Now, if you have a Roth 401k, it's going to actually deposit 5% of your post-tax income. So say, for example, and again, to keep math easy, say you had a 50% tax, right? So your paycheck only comes out to be $50. If you live there, you need to move. But for math's sake, we'll go with that. So now your check, your post-tax is going to be down to $50. Now what it's going to do is that 5% is going to be $2.50. So then your 401k will add $2.50. Now the benefit though of a Roth is the fact that you've already paid taxes on it. So the logic behind going the Roth route is that if you believe that eventually you will be when you retire and you will start to withdraw on this money, is that you will be in a different tax bracket. So someone, for example, who is currently making $50,000 and you're in a tax bracket where you're paying, 13% or whatever along those lines that it might be, you might look at that and say, well, it's worth it right now for me to go ahead and pay pre-tax because of the tax bracket that I'm in, as opposed to whenever I go to retire, because maybe I'm making more money, whatever it might be, whenever I get to 59 and a half and so on and so forth. So you have to think about where you're going to be at tax-wise, because it might make more sense now to pay that tax up front rather than whenever you retire. So again, think about it. Think about what your career projections look like. I know a lot of you are probably younger and you're not really thinking about retirement at this point, but really what you're doing is you're kind of trying to set yourself up for success. So like we mentioned, there's not going to be any taxes on your Roth whenever you withdraw it upon retirement, because that's taxes that you've already paid. Another big benefit that you get with a Roth as opposed to a traditional. So a traditional and a Roth, you can both withdraw once you turn 59 and a half without penalty. Now, if you have a traditional 401k and heaven forbid you have an emergency and you need to withdraw money from that, you will pay a penalty. With a Roth, because you've already paid taxes on that money, you only have to hold it for 5 years. If you withdraw from it before 5 years, then you will have a penalty. But if you do hold it for 5 years, you won't actually face a penalty on it. Now, again, because it's a retirement, the goal is to not touch it until you plan to retire. But again, circumstances come up sometimes that are outside of our control, and there's nothing that we can do. And so if you need to do it, a Roth is going to be a better option, because again, you've already paid your taxes, and so you won't encounter a penalty on that. Another one is max contributions. So max contributions are essentially the IRS saying this is what your maximum contribution that you can do every single year into your 401k. And again, without getting into Fed policy and inflation and so on and so forth, you will notice that over the years that number kind of tends to grow. Every few years, it'll probably go up another $500 or so. The current max contribution is $19,500. Now, if you are over the age of 50, what you can actually do is what they call kind of a catch-up contribution. And that catch-up contribution is basically saying, well, when you were 20, you may not have been contributing as much as you would like to, maybe because your income was lower, whatever that condition might have been. We're now allowing you to invest an additional $6,500, and that will increase your maximum contribution. Again, assuming we're in 2020, it would bump it up to approximately $26,000. Now, if you are investing $26,000 a year into your 401k, congratulations, you're killing it. Most of us are not. I fall into that boat, and my guess is the majority of you probably also fall into that boat. But one thing, though, that we can take into consideration is employer contribution matching. So, for example, if you have an employer that matches 100% of 5% of your contribution, at minimum, you want to put in that 5%, because as most people say, that's essentially your employer giving you free money. That's applying towards your 401k. So that's kind of a rundown as far as the differences between your 401ks, your traditional 401ks, and your Roth 401ks. Now, a lot of you guys are saying, well, I'm not working for a traditional company. I don't really have an offering for a 401k, or maybe you're like a lot of us, where you're transitioning from a full-time career, and maybe you're going into the entrepreneurial world, and you're thinking, well, what types of opportunities do I have as an entrepreneur, and what type of retirement plans can I go into, as an entrepreneur and owning my own business? So you have three options. And some of them obviously are going to be better, but again, you need to weigh these and make sure that you understand what is best for you long term when you're thinking of your retirement. So the first one is a SEP IRA, and that stands for Simplified Employee Pension. And what that's doing is it's allowing you to contribute up to 25% of your income, up to $56,000 in 2019. Now, it is also tax deductible. So for example, if you're like me, where you're currently working full time, and then you have a side business, whatever it might be, and you don't necessarily need that, you could potentially look at a SEP IRA and put all of your profitability, all your money that you're additionally making, into a SEP IRA for retirement, and it is tax deductible. So it's tax deductible, which is great, which means that you can claim it on your taxes, as you can for a lot of things that involve entrepreneurs and businesses. I'm not an accountant. Definitely talk to your CPA as far as that goes. But again, those contributions are tax deductible, which is great. One of the other great parts about it is that you can actually wait until after you pay your taxes to contribute it. So say, for example, you're in a scenario where maybe you don't make a ton of money with your business, but you make some, but your fear is that you're actually a little bit nervous to invest into your retirement because you're not exactly sure what your tax bill is going to look like. You can actually deposit money into and contribute to your retirement after your taxes are paid. Now, again, the benefit of that is going to be if you're in a situation where you're just not sure what that tax bill is going to look like. I'm pretty sure that I'm not burning any bridges or stepping on any toes here when I say no one really likes the IRS. Part of it is the fact that it lives in this ambiguous, vague world where no one really knows exactly what they're supposed to pay. So maybe you're a little bit nervous when it comes to that kind of thing. So you actually have the opportunity to be able to wait. The second one is a simple IRA. So the simple actually stands for Saving Investment Match Plan for Employees. And so you can actually contribute this one even after you've hired an employee, but it is a requirement that you would need to match your employees' contributions up to 3% of their pay. So this kind of goes into where we talk about having employees, the types of opportunities that they have as employees when it comes to retirement. This one does require some employee matching. And there's also a contribution limit of no more than $13,000 or $16,000 if you're over the age of 50. Again, that kind of goes along the lines of the catch-up contributions. And then also too, another thing is that if you do withdraw from that account within 2 years of opening it, you would face a 25% penalty. So similar to the traditional 401k, if you needed to withdraw from that, or a traditional IRA, you would also suffer a penalty. So you've got that 2-year buffer period where if you do put money in there, you can't withdraw from it. So the big thing there is say, for example, you make a huge sale and you're like, yes, I'm crushing it. I'm going to put 15 large in my simple IRA account. You can do that, but then say, for example, those next few months of sales aren't panning out the way you want to. You can't just go in and pull that money back out without having to pay a penalty. Now, another one is actually called an individual 401k. Now, an individual 401k is basically when you say that you are your own employee. You also do have the flexibility to be able to add a spouse. So you can also have a spouse in an individual 401k that works for you. And then when you're the boss, you can also contribute an additional 25% of compensation in addition to your employee contribution for a $56,000 maximum. So essentially what that's doing is kind of like what we talked about earlier, where if you've got a side business or something along those lines that's doing pretty well, but you don't necessarily need the money, you can find ways of being able to attribute that and allocate those funds towards a retirement. An individual 401k might also be an option. Another benefit of doing this, and part of the reason for doing that is because, say, for example, similar like we were just talking about with the simple IRA, you have 1 year where you just crush it, right? Like you were just killing sales. Your profitability is through the roof. You couldn't imagine have been doing a year as well. But maybe next year's not so good. Maybe you lose a big client. Maybe something happens to where your costs end up going up a lot higher than you initially planned. What this does is it allows you to basically say, on these good years, I'm going to contribute up here. That's my plan. On these down years, I'm only going to be able to do down here. So it helps and helps you to be able to adjust with some of those ebbs and flows with most markets that we see. And then what I wanted to do after this is, after going through those, is talk a little bit about rollovers. So, for example, I know we've talked about on this show a lot of industries that have been hit very hard. The big ones being anything in hospitality, ranging from, restaurants, food trucks, bars, so on, and all the way up to airlines. Your major airlines, obviously, significant trouble in terms of passenger travel, and then everything in between, everything from parks, live music venues to hotels, even hospitals at this point. A lot of hospitals are also struggling and laying off people because a lot of the elective surgeries that people were having, they had to lay people off because people who had elective surgeries that would have been paying a lot of the hospital bills, they're not there. A lot of wards are less than capacity. They're and so the work just wasn't there. So one of the benefits of what I want to go into now is that you started a new job, you started a new opportunity, maybe it's a different company. What are your options with your 401k, whether it's traditional or Roth, that you had at your old employer? Now, you do have the opportunity a lot of times to roll it into your new 401k, but what you also have the option to do is you can also roll those into like a rollover IRA. So you have a rollover Roth and then you have a rollover traditional. Don't make the mistake that I did, which is whenever I opened up, I had a traditional and I had a Roth IRA that I actually ended up just kind of contributing money to all of them. And it was like, oh yeah, that makes sense. But what I noticed is I was contributing post-tax dollars into pre-tax and post-tax dollars into post-tax and so on and so forth. And that part can get kind of confusing. So just make sure that whenever you're working on this, that you're understanding the differences between your pre-tax and your post-tax. And if you do intend to make any additional contributions to your IRA, that you understand the difference and then you put that money into the right place. So what I want to talk about, like I mentioned, is 401k rollovers. So what is a 401k rollover? A 401k rollover is essentially you no longer being at an employer where you were making, whether it was bi-weekly, weekly, monthly, quarterly, yearly contributions to your 401k into an account that is with a firm that is partnered with your employer, that basically manages it. Either they manage it or they allow you to pick the funds that you want to invest in, and things along those lines. But basically you could log into a 401k website and you can kind of keep an eye on it there. If you're no longer there, you don't really have that option. You don't really have the ability to continue to put money into it. You don't really have a lot of the flexibility that you could have where you could go in and you can reallocate. Now, you can leave it there, but one of the things too that you may also find when we talk about fees, you might be paying a higher fee by keeping your 401k in a prior employer than it would be if you were to roll it into either a new employer or roll it into an IRA. So again, like I mentioned, we have a traditional IRA and then you have a Roth IRA. And one of the things about a Roth IRA though is that you also, if you make over a certain amount of money, you are actually unable to contribute to a Roth IRA. And how that is calculated is based off of the MAGI. That is MAGI, and it stands for Modified Adjusted Gross Income. So I'll say that again. The MAGI is Modified Adjusted Gross Income. And what that means is, I'm sure a lot of you are like, never heard that before. And what that means is that if your household adjusted gross income with any tax-exempt interest income and certain deductions added back is over $139,000, then you will be unable to contribute to a Roth IRA. Now, I think based off of, if you've listened to any prior shows, $139,000 based solely on income, probably puts you in like the top 10-ish% of income earners in the US. So chances are the majority of people that are listening to this probably don't necessarily fall into that category. So it's nothing that you have to worry about, but that's a good goal, right? All of you should be striving to, and as like we talked about before, all of you should be striving to be as successful as you possibly can be. And if you're trying to figure out whether or not you're able to invest money into a Roth IRA, then you are doing a great job and you should keep doing that. Keep doing what you're doing. Keep killing it. If you're not there yet, I'm not there. If you're not there yet, let's get there together. Let's keep working to where eventually we have to figure out, we're making all of this money. What are we going to do, as far as retirement goes? I got to figure out what I can invest my money in to make sure that I'm set up for the future. So like I said, let's get that together. But again, MAGI, Modified Adjusted Gross Income of $139,000. One of the other benefits that you may find if you are leaving an old employer and starting at a new employer is some cash incentives. What that means is that there are a lot of firms out there that want your money. They want your money. As I'm sure most of you are pretty aware, that's how banks make money. Banks make money. Well, again, we don't want to talk about the Fed and monetary policy and that kind of thing. But essentially the way banks make money is that you give them your money and then they turn around and they loan that money back out, right? So a lot of banks, a lot of firms are offering cash incentives, and you guys may receive coupons in the mail and that kind of thing for opening up accounts. Some of them require easier things like direct deposits, whatever it might be, certain types of account activity. But then also too, some of them are balances. So for example, Merrill Lynch, who I believe is an arm of Bank of America, I think right now has a coupon or something along those lines going, and where if you invest a certain amount of money with them, and I apologize, I'd have to get what the actual amount was, but we'll say it's $20,000. They basically say, well, if you invest $20,000 with us here at Merrill Lynch, we'll give you $600. We'll just give you $600 in cash. Now, they're not going to come to your house and, give you $100 bills, but they'll deposit the money for you, and that's kind of an incentive for you to be able to deposit that money in those accounts. I know another big one, Chase tends to offer a lot of incentives as well. For me, for example, when I opened up my business account, if you deposit a certain amount of money as well as have a certain amount of account activities, they give you $300. And then I got a credit card to where if you spend X amount of money within the first 3 months, then they give you an additional $500. So what I mean by this is that when you have a 401k and you're rolling it over, you're the boss. You get to choose where that money goes. And looking at a place with cash incentives is a big goal. I mean, you can make a decent little chunk of change off of that. But one of the things, though, too, that you have to consider is management fees. So, for example, I don't know exactly what Merrill Lynch's management fee is, but maybe their management fee, and I'll make this up because I'm sure it's not that high, but say it's 5%. Right. So now you deposit your $20,000 and now they're taking 5%, as their management fee. Now, again, it's not going to be that high, but you have to look at that and go, well, sure, you gave me $600, but then look at all this money that you're taking from me on a yearly basis. Ideally, what you could probably do is you could find somewhere that's around 1/4%. I know Vanguard is the biggest. I think Vanguard, in terms of investments, I think they tend to hold one of the largest in the world. And most of their accounts are about between 1/4% and 0.3%. Vanguard is generally who I tend to recommend people to go with, mainly because they're flexible. Their service is great. Their management fees are low. It's a name that everybody is familiar with, and so they have that reputation. But again, maybe management fees are your concern. If you're rolling in $100,000. The management fee could actually make a pretty decent impact, as opposed to if somebody was just like, oh, well, if you open it, I'll give you $200. And then there's also non-traditional types of retirement accounts and IRAs. One of the big ones that I found, and I don't use them personally, but I think the concept is really cool. I remember whenever I was back in college, I had a Bank of America account, or maybe it was SunTrust. It was one of those two, but it was like a keep the change account. And so basically what it was, and I'm sure a lot of you have probably heard of them as well, but you make a purchase for $25.25. Well, it would round up to 26, and then it would take that 75 cents, and then it would deposit that into savings for you. But there's a platform that's called Acorns that it basically does the same thing. You set up a retirement account with Acorns, and as you make purchases and so on and so forth, that money that's left over as it rounds up would actually get deposited into the account. So look at what you think would best suit your needs, but this is the type of stuff where it's very important for you to be aware of. As we talk about on this show and as we talk about on social media, financial freedom and financial success are very intertwined. And if you're not understanding and if you're not super familiar with what the money that you have accumulated that you intend to retire on, then how are you going to be able to manage your finances on a day-to-day basis or a week-to-week basis or a month-to-month basis? How are you going to know where to make capital investments? If you're not familiar enough with, hey, this is the money that I plan to live on whenever I retire, how are you going to be comfortable enough to be able to make those types of decisions? So I know that was a lot of information. I wanted to try to get it in about a half an hour, which we did. We did pretty good. But again, great news as far as the vaccine goes. I really hope that it's going to allow this country and the world to really be able to kind of make a 180 and go back towards business operating as normal. And congratulations again to a lot of you out there who have started new jobs, or maybe you got back on at your old job. I really hope that this information was super helpful, especially for those of you, and I know we talked about this on prior shows, that have started their own business. 2020 had a lot more EIN applications than 2019, and so hopefully these additional retirement accounts for entrepreneurs was also valuable and helps shed a little bit of light on what you can do as an entrepreneur when it comes to retirement. So thank you guys all for tuning in today. If you have any questions, by all means, please feel free to reach out, tweet us, send us an email, whatever works best for you. But hopefully we helped out a lot, and hopefully you learned some things today. And we'll talk to you again next week. All right, thanks a lot. Bye.